Our 5 minutes break is over. Now we go to the balance sheet. But before we do the balance sheet, let's work out the investment in associate now that we have the associate. Can we do the investment in associate now that we have the associate? Yes, let's do the investment in associate. How do you do? Because we say that you don't consolidate a subsidiary, an associate, sorry. You don't consolidate an associate, but you recognize what we call investment in associate. Therefore, let's recognize investment in associate. Investment in associate. That is the only item we recognize in the balance sheet. In the income statement, you only recognize group share of profit or loss after tax. But in the balance sheet, you recognize an investment in associate. This one, you take the cost of investment. Cost of investment. The cost of investment is what you invested in the associate. That is 1920. That is what we invested in that associate, 1920. Then we come to our group share of profit after tax. That is 40% times 600 loss. Profit after tax is a loss of 600 times 6/12. Because it was for 6 months. It was for 6 months. Therefore, that loss, it's a loss before tax, loss in associate. When you check in the associate, Florence will ask, where are you getting 600? You check in A Limited, the loss is 600. Out of that loss, it was for 6 months. Then we take 40%, that comes to 120 loss, we less. It's our loss, we less. It's our loss, we less. Then I also less impairment loss. Impairment loss, of which we had impairment loss of 80. Impairment loss of 80. I also less UPS on closing stock. This one we did not have it. We did not have it, therefore we get investment in associate. Investment in associate there. We get investment in associate. You take the cost of investment, how much they invested that associate. We add group share of profit after tax. In this case, it was a loss of 600. 6/12 times 40%. Impairment loss in associate was 80. Then we less UPS, it was not there. I'm getting 17 what? 1720. That's the investment in associate, and that is the only item you recognize in associate. That is the only item we recognize in associate. Any question up to that point before we do the balance sheet? Any question up to that point? If there is no question, now let's do the balance sheet. Let's do the balance sheet. If there is no question, let's do the balance sheet. Let's do the balance sheet. We say head group. Statements are consolidated. We say consolidated. Statement of financial position. Consolidated statement of financial position as at 31st March 2020. You underline your work using the ruler. Don't do it like Marino. You underline very well your work using the ruler so that you impress the examiner there. Shillings in millions. Shillings in millions. We start with non-current assets. Non-current assets. Non-current assets. Non-current assets. That one we have PPE. I will take the PPE of 25,000. plus 16,300 plus 200 revaluation. Revaluation, that is 200 minus 10 depreciation. Fair value adjustment. Fair value adjustment of 200 minus depreciation of 10. We add fair value adjustment on PPE 10. Then I have brands. Brands is 300 minus 25 amortization. I get 275. That is brands. Fair value adjustment on brands. Note number 1, 300 minus amortization. Then I come to goodwill. Goodwill was it 27 something? 27, was it 2765? I don't remember very well. Goodwill. Thank you very much, Ruth. 2765. Then investment in associates. Which is 1720. 1720 investment in associates. Then in the balance sheet, when you check in the balance sheet, we have financial asset of 250. Financial asset of 250. That financial asset is the loan that was given to S. Therefore, you don't consolidate financial asset. Financial asset, I will take 250 minus 250. That is in the company owing 0. 250 minus 250 because it was a loan given to S. When we go to the loan of S, we shall also subtract 250 in the company owings. We subtract because H gave a loan to S. To H, it is an investment. To S is a loan. Then we go to current assets. Inventory. Inventory is H 67 plus 6,000 minus 30, the UPS. On inventory, always you subtract the UPS if it is there. Total UPS. Always you subtract UPS. Receivable. 41, 50 plus 1,000. That one I will do it for you, 51, 50. Cash and cash equivalent. Cash and cash equivalent, 1980 plus 400, that is 2380. Then you give me total assets. You give me total assets. We are done with the assets. You give me total assets. You give me total assets. You give me total assets, then we go to capital and reserves. Capital and reserves. Capital and reserves. Ordinary share capital. Share premium. Now, when we come to ordinary share capital there, let me explain something. Allow Mwalimu to explain something. Allow Mwalimu to explain something on ordinary share capital. On ordinary share capital. Allow Mwalimu to explain something on ordinary share capital. Now, when you go to introductory part there, we issued shares as purchase consideration. I'm going back to the introductory note. We issued shares where it was for every 2 you get 1. What about 400? It was 400 times 1 divided by 2, which was 200 times 30. I want to explain something. We got 6,000. 6,000. I want to explain something there. We got 6,000. Now remember, examiner said that we have not accounted for this acquisition issue of shares. Examiner said, H Limited is yet to record the consideration on acquisition of ordinary shares in S. Therefore, we issued shares, but we have not accounted for that. Therefore, this one, I need to account for that. I need to account for that. Listen very carefully. I need to account for that. How am I going to account for this? Remember, issue price. Issue price was 30. Par value was 10. 10. Therefore, the difference is premium, share premium. 20. 20 is the share premium. 20 is the share premium. Therefore, for me to account these 6 million of shares, for me to account for them, I will take 200 times 10 par value, I get 2,000. That goes to the ordinary share, 2,000. Then again, I take 200 times 20, I get 4,000. That goes to the premium. Total is 6 million there. Total goes to the premium there. Total goes to the premium. Therefore, we have the par value and the premium. Then when I come here, for the parent, I'm taking 8 million for the parent plus 2 million, I get 10,000. Issue of shares, 10,000. For the share premium, I'm taking 4,000 plus 4,000. I get 8. Why are we adding? Because the examiner said that we had not accounted for the issue of shares. We had not accounted for it. Therefore, my name is just accounting for that. We have accounted for the issue of shares. Then I go to retained earnings. Retained earnings. This one, I have not done the consolidated retained earnings. I put a dash. I have not done it. Non-controlling interest. Non-controlling interest. I have not done non-controlling interest. I put a dash. Then I move on. I have not done it as at now. My name is just putting a dash. And also in an exam, just learn how to work smart. That is how you work smart. You put a dash. Because that item will take your time, But the rest, as you can see, you cannot take time, just addition. It cannot take time. But when you come to retained earnings and NCI, we are going to do the computation. I believe the issue of shares we have understood there. Why Marimu is adding? Because it had not been recorded. But suppose it was recorded. Suppose it had been recorded. Then you don't add. Suppose it had been recorded. Then you don't add. Then we come to non-controlling and non-current liabilities. Non-current liabilities. We come to non-current liabilities. I have loan. %8 loan note, which is 7,600 plus 2,000 minus 250. Now, I already explained that 250 is intercompany owing. To H, it was an investment. To S, it's a loan, therefore I'm subtracting from the loan. That one is intercompany what? Owing, therefore we subtract. Then I also report deferred payment. Deferred payment. The payment I will pay in 2 years' time, it has become a liability to the parent. Therefore, I will take 83 plus 83 times 6 over 12 times, times 10% past interest times 6 over 12. Deferred payment. Deferred payment. Remember, I have the money that I have not paid. And remember, the interest is 10%. Therefore, I'm also adding the interest. 83 plus the interest that will accrue on that at 10% for 6 months. We add there. We consolidate that item like that. Deferred payment, we have not accounted for it. Therefore, we have not included in our liabilities. Then I come to current liabilities. Current liabilities. I have payables. Payables, I take 55 plus 52. That one I will do it for you, 10,700. That one I will do it for you for free. 10,700, you just add. Current tax, current tax. Current tax is 28 plus 23. 2,800 plus 23. You get probably 51. Then you give me total equity and liabilities. Total equity and liabilities. I believe you are getting figures there so that you, at the end, you get total equity and liabilities. Total equity and liabilities. Now, the only item we are remaining with is the NCI and the consolidated retained earnings. I want us to compute them right away. The only two items that are remaining is the retained earnings and the non-controlling interest. Let's begin with NCI. Let's begin with NCI. Fair value of NCI. Fair value of NCI. Here, you take NCI at a fair value of NCI at acquisition and acquisition. Fair value of NCI at acquisition. You come and add NCI share of post acquisition profits. NCI share of post acquisition profits. Then you get NCI at the end. NCI at the end. You take the fair value of NCI at acquisition, of which it was 1,800. The one we computed, you could win. Of course, it was what? 1,800, if you remember very well. Then you come to add NCI share of post-acquisition profit. NCI share of post-acquisition profit was 260. If you remember very well, it was 260. 260, where we took 1,300 times 20%. If you have forgotten, that is 260. That is post-acquisition profit of NCI. Post-acquisition profit of NCI. You add to the fair value at acquisition. How did we get fair value at acquisition? We took NCI shares times the market price of the shares in S. I'm just reminding you. but I believe you know now, even you are saying, why is Mwalimu making noise there? Because I know you know. Okay, how much is our NCI there to be consolidated? 1800 plus 260. I'm getting 2060. 2060. That is my NCI at the end. I just come here and put NCI 2060 like that. 2060 like that. 2060. Then we come to the last item, which is the retained earnings. Retained earnings. Now, let me show you how we get the retained earnings. I believe this one we are okay. I believe we are okay there. Let me show you how we get the retained earnings. This is why we are doing it as our last item, because if you start with it, it will take a lot of your time. But the balance sheet itself, you can take like 5 minutes. But that item can take you like even 15 minutes. Therefore, we do it last. We do it last. Let's do the consolidated retained earnings. Consolidated retained earnings. Consolidated retained earnings. This one we take 100% profit of the parent from the balance sheet. Of the parent from the balance sheet. You take 100% profit of the parent from the balance sheet. Of course, it is 12,100. 100% profit of the parent. Then you come to add group share of post acquisition profit in the subsidiary. In the subsidiary, you come and add group share of post acquisition profit in the subsidiary. Of course, it was 1300. We already computed times 80%. We got 1040 like that. You come to add group share of post acquisition profit in the subsidiary. Then I also come to add group share of profit after tax from associate from associate. It is part of the retained earnings of the parent, which will be a loss of 600 times 6/12 times 40%, which is 120 loss. Therefore, I less because it's our loss. I less because it's our loss. I less because it's our loss. Then I come and less impairment loss. Impairment loss, of which we had impairment loss of 810 in associate. It's our loss to the parent. Impairment loss, any impairment is our loss to the parent. Therefore, you less impairment loss there. Impairment loss. I also come to less UPS, where the parent is the selling company. UPS, where parent is selling company. But in this question, I put a dash because the UPS was from the subsidiary. We subtracted from the subsidiary. If it was the parent, then I less there. Less UPS where the parent is the selling company. In this case, the subsidiary was the selling company of the goods. Therefore, it's not affecting. Then I also come to less unaccounted expense on deferred payment, deferred payment. Unaccounted expense on deferred what? payment, an accounted expense on deferred payment, that is 8,300 times 10% times 6 over what? Over 12, where we have 415. You come to less 415, that interest has not been accounted for in the retained earnings of the parent. Therefore, I come to subtract it there. I come to subtract it there. And then nothing else. Therefore, you give me the consolidated retained earnings. You give me the consolidated retained earnings where I'm taking 12,100 plus 1040 minus 120 minus 200 minus 80 there minus let me repeat again. 12,100 minus plus 1040 minus 12,525. I don't know what you are getting there. I'm getting 12,525. That is the consolidated retained earnings. Therefore, I come to 40 there. 12,525. 12,525. That is what I'm getting. 12. Thank you very much, Edwin. You are also getting the same 12,525. Therefore, that becomes the retained earnings to be considered. I know it is tricky there, but it's not that tricky because Mwalimu is showing you how you get it. You take 100% profit of the parent, you add group share of post. Remember, Mwalimu is using the word post, not total. Post acquisition profit in the subsidiary, group share of profit after tax or post acquisition profit in the associate, or if you have the joint venture. Then we less impairment loss, a subsidiary or associate, you less. Then you less UPS, where the parent is the selling company. Because if the parent is the selling company, you don't subtract in the subsidiary. If the parent was the selling company, listen very well, listen very carefully. If the parent is the selling company, you don't subtract the UPS in the subsidiary. You don't subtract in the subsidiary, but you come to subtract in the parent. Then any accounted expense, like on this case, we have an accounted expense on deferred tax. The parent deferred expense, the parent has not accounted for that. Therefore, we do what? We account for that for 15. Then we are done with that item. Therefore, tomorrow we meet, we are going to discuss piecemeal acquisition. Piecemeal acquisition or step acquisition is where you acquire a company but in steps. You acquire a company, a subsidiary, but in steps. Then after that, we look at disposal of shares in a subsidiary. Then after that, we look at foreign subsidiaries. Then we shall be done with group accounts. Therefore, this is just the introduction of group question. Next, tomorrow, we are going to discuss piecemeal acquisition. Therefore, it's very important that you attend tomorrow's class. It starts exactly at 5 p.m. Piecemeal acquisition. It will be group lesson number 4. Piecemeal acquisition. Then we go to disposal of shares, lesson number 5. We go to foreign subsidiary, lesson number 6. Then we shall be done with the group. We go to group cash flows. Then we are done. Bye-bye. Thank you very much for your time. But make sure that you fill in the blank spaces. You fill in the blank spaces until your balance sheet balances. Thank you very much. Bye-bye. Let's meet tomorrow at 5 p.m.